All right, let's talk about SoFi Technologies, ticker SOFI. The market is, of course, closed for the weekend, and we have a chance to really dissect what's going on with this name. On Friday, November 7th, 2025, the stock closed at $28.21. That was a really strong move, up 3.87% or $1.05 on the day. And the buying didn't stop at the bell. In after-hours trading, it tacked on another 19 cents, or 0.67%, to sit at $28.40. Now, the immediate expectation when you see a 3.87% pop on a name this volatile is, oh, it's just SoFi being SoFi. It's just day traders on the Robinhood app and SoFi active investing platforms chasing momentum. The common belief is that this is just another fintech stock, a neobank that's all marketing flash and no real substance, lumping it in with other high-growth, no-profit names that were darlings a few years ago. But the reality of what's happening here, what that $28 price tag and that strong close might be signaling, is something far more profound. That move isn't just noise. It's the sound of the market, however grudgingly, starting to re-rate this company. The expectation is that it's a fintech app. The reality is that it's a fully chartered national bank. And that 3.87% move is a sign that the big institutional desks are starting to wake up and realize the difference. The common ground for almost every bear and skeptic is that SoFi is a student loan company that got lucky, a one-trick pony that was built for a zero-interest rate world. The narrative is that its core business, student loan refinancing, was decimated by the multi-year federal loan moratorium. And now, in a high-rate world, that business is still tough. The expectation is that the only way SoFi can get new customers is by spending an absurd amount of marketing, like putting its name on a stadium just to get people to open a SoFi investing account and buy a few SoFi ETFs or SoFi stocks. The bears see this as a company built on a high-cost, low-loyalty member base, a place for online investing gambles, not for a serious investment. They look at the stability of an Apple stock or the clear dominant growth of an Nvidia stock, and they see SoFi as a high-risk speculative bet that's burning cash to acquire users who will flee at a moment's notice. But let's challenge that. Let's really look at the other side. The expectation is that SoFi is a marketing company with a banking app. The reality is that the bank charter, which they fought tooth and nail to get, has fundamentally rewritten the entire equation. That's the part the market is still struggling to price correctly. It's not just an app, it's a full-stack financial institution that can hold deposits. Thanks to its high-yield SoFi savings and checking accounts, it has attracted tens of billions of dollars in low-cost, sticky deposits. This is the whole game. While its competitors have to go to Wall Street and borrow at high floating rates, SoFi can use its own members' deposits as a stable, low-cost source of capital. It can then turn around and lend that out in the form of personal loans and increasingly home loans at a much higher rate. This creates a massive, expanding net interest margin, the core engine of profitability for any real bank. That 3.87% jump on Friday wasn't just a retail-driven sugar high. It was a reaction to new data from its recent earnings, which showed this exact flywheel spinning faster and faster. The company is, by all accounts, on the brink of sustained GAAP profitability, and that is not what you expect from a simple fintech app. Let's dissect the recent movement and the macro pressures, because this is where the entire story lies. That 3.87% move on Friday, which pushed it to $28.21, came on the heels of a blockbuster Q3 earnings report. The company reported record revenue, record net income, and record member growth. They added nearly 1 million new members in a single quarter, bringing their total to 12.6 million. That is not a sign of a slowing business. The market is being forced to reckon with the fact that the member growth is actually accelerating as the company becomes profitable. This is the holy grail for a growth stock. But the macro pressure is the real story. This high interest rate environment, which was supposed to kill SoFi by crippling its loan demand, has actually been its greatest weapon. How? Because it allows SoFi to offer a 4.5 or 5% yield on its savings accounts, which is massively attractive to consumers. It has become a flight of safety for deposits from traditional banks that are still paying 0.1%. So high rates, which are a cost for other lenders, are a member acquisition tool for SoFi. This is a brilliant strategic jujitsu. The stock is still incredibly volatile, of course. This is not a name for a passive intelligent portfolio or a Schwab Intelligent Portfolios account. It's a battleground. The short interest on this name is still stubbornly high. There is a massive contingent of traders, many using Interactive Brokers for its sophisticated Interactive Brokers trading platform, who are betting that this will all fall apart. They're betting that the personal loans, which are SoFi's main profit driver, will see a huge spike in delinquencies as the economy softens. They are betting these high-yield deposits are not loyal and will flee for the next best rate, forcing SoFi to raise its deposit costs and crushing its net interest margin. That 3.87% move on Friday was a direct shot at that bear thesis. So, what does SoFi Technologies actually do? It's really three businesses in one, all designed to work together in a flywheel. The first and most visible is the financial services segment. This is the app, the one-stop shop you see in the ads. This includes SoFi Invest for online investing, a SoFi robo-advisor, credit cards, and the Robinhood cash management style checking and savings accounts. This segment is the top of the funnel. It's intentionally a low-revenue, high-marketing spend part of the business, designed to get millions of members into the ecosystem. The second leg is the lending segment. This is the profit engine. This is where they offer personal loans, student loan refi, and home loans. The magic is the cross-sell. They get you in the door with a free SoFi stocks account. Then, using their data, they offer you a personal loan when they see you need one, funded by the deposits from their savings account members. This is what Fidelity Wealth Management divisions at big banks have done for decades, but all in one clean, digital package. The third and most understood leg is the technology platform. This is Galileo and Technises. This is SoFi's B2B AWS for Fintech business. They provide the back end, the plumbing, like core banking software and payment processing for other fintechs and even traditional banks that want to invest online. This is a high-margin, capital-light business that many investors on the Fidelity mobile app just completely ignore, but it's a huge part of the long-term bull case. This brings us to the future outlook. There are really only two paths from here, and that $28.21 is the market standing at the crossroads. The bull case, the reality that the bulls are betting on, is that this is it. The company has achieved escape velocity. They are now sustainably GAAP profitable, as their last few quarters have shown. The bank charter advantage is only just beginning to show up in their net interest margins. The financial services segment will slowly turn from a cost center into a profit center. The tech platform will grow as more banks and fintechs need their services. In this scenario, SoFi isn't a $28 stock, it's a $100 stock. It's not a fintech, it's a high-growth bank that also owns a high-growth tech company. It's a name that Fidelity ETFs and Fidelity mutual funds will be forced to add to their holdings as a core position, not just a Robinhood stock trading level speculation. Then there's the bear case. This is the reality where the skeptics are right. The expectation is that the $139 million in Q3 net income is a peak. In this scenario, the economy does roll over hard. Those high-earning, prime borrowers in the personal loan portfolio start to lose their jobs. Delinquencies and charge-offs don't just tick up, they spike violently. The high-yield savings deposits, which looked so sticky, prove to be hot deposits, and they flee for the next best rate, forcing SoFi to raise its deposit costs and crushing its net interest margin. The student loan refi business never really recovers. The tech platform, Galileo, continues to face slowing growth. In this reality, the company's profitability vanishes, the cash burn returns, and the stock is exposed as just another high-risk lender in a tech company's clothing. It's a painful round trip back to single digits. This isn't investment help you want to hear, but it's the risk that every individual brokerage account holder must understand. This is the core tension. The expectation is that this is a 2021-era app-based fintech. The reality is that it's a 2025-era bank-chartered, profit-driven financial institution. I'm genuinely curious what